Welcome to F4 Corporate and Business Law. In this section, I will go over share capital. Let's first define what is share capital. Share capital is all the funds raised by a company in exchange for shares. There may be different classes of shares that a company can sell to raise capital. Not all shares sold will result in the shareholder having ownership or control in the company. The amount of share capital a company has can change over time. A company can get authorisation and issue more shares to raise more share capital in the future. The statement of capital and initial shareholdings shows the company's share capital at registration. Under the UK Companies Act 2006, these must be provided when registering a company. In the statement of capital and initial shareholdings, the following information must be given. Total number of shares of the company to be taken on formation by the subscribers to the memorandum. The aggregate nominal value of those shares. And for each class of shares, the prescribed particulars of the rights attached to those shares, the total number of shares of that class, the aggregate nominal value of shares of that class, the amounts to be paid, and the amounts, if there are any, unpaid on each share. The statement of capital and initial shareholdings must also have the following information about the subscribers: the number of shares and their nominal value, and the class taken by the subscriber on formation, the amount to be paid up, and if relevant, the amount unpaid on each share. You will hear the terms authorised share capital and issued share capital. What do those terms mean? Authorised share capital is shares that have been authorised in the constitutional documents of the organisation. It is the most shares that a company can issue. Issued share capital are shares that have been issued or sold to shareholders. The class of shares are outlined in the registration documents. What share classes are there? The main ones are ordinary shares that raise ordinary share capital, preferential shares that raise preferential share capital. Let's look at these in detail. Ordinary share capital. Ordinary shares give shareholders ownership of the company. Ordinary shareholders can vote at the AGM. Dividends are paid to ordinary shareholders at the management's discretion. It is not obligatory to receive a dividend. In fact, some shareholders prefer that their shares increase in value and can be sold at a profit rather than regular dividend income. And some shareholders want their investment to generate a regular income. It all depends on the shareholder profile. Ordinary shareholders are entitled to the residual share of the company's assets based on their shareholding when it is being wound up. In this event, shareholders are the last to get paid, therefore take more risk. Ordinary shareholders will also be paid their dividends after the preference shareholders. Ordinary shares form part of the equity of the company. Preference share capital. Preference shares do not give shareholders ownership of the company. Preference shareholders cannot vote at AGMs. Preference shareholders are not entitled to the residual value when the company is wound up. Instead, they will be repaid the amount they invested prior to the ordinary shareholders receiving their residual. Preference shareholders are seen as a mixture of equity and loan capital because they don't have ownership of the company and are similar to a loan. The preference dividend can be either fixed or at the discretion of the directors and they are paid ahead of the ordinary shareholders' dividends. There are two types of preference share. Redeemable preference shares, which have a fixed repayment date similar to a bank loan. Irredeemable preference shares, which have no fixed repayment date, similar to ordinary share capital. There are also preference shares called cumulative preference shares. These shares accumulate a dividend. So if, for example, dividends can't be paid one year, the next dividend paid will be for the current year and the years where the dividend was missed. The dividend accumulates. So now you know the main two classes of shares. It is useful to see the key differences between them. The main difference is ownership and control. The company is owned by its ordinary shareholders, who can vote at AGMs. If an ordinary shareholder is not happy with the board of directors, they can air their opinion at the AGM and vote for change. When more ordinary shares are issued, the control of the shareholders is diluted. Preference shareholders don't have any of these rights. However, their investment is seen as less risky than that of an ordinary shareholder. They are paid before ordinary shareholders and have a more predictable income in the case of redeemable preference shares. But with investments, the greater the risk, the greater the potential reward. Ordinary shareholders' dividends could be much higher than preference, and their value could appreciate more than preference shares. Now, let's examine Treasury shares. These are the shares that a company has, but have not been issued to outsiders. The company may have them because they didn't sell all of its issued share capital, or they may have bought back shares in a buyback. You learned that ordinary shareholders control the company, and when more shares are issued, the original shares control is reduced or diluted. What would happen if a company bought back shares on the market? There would be less shares, right? Less shares mean the shares left would have more power and would earn bigger dividends per share. Treasury shares have no voting rights, should be excluded from share earnings calculations. They can be sold by the company to raise extra capital at a later stage. They can also be kept so they can be sold to avoid a hostile takeover. You saw earlier that the rights of each share class are outlined in the Statement of Capital and Initial Shareholdings. Typically, these rights are voting rights, rights to dividends, and rights to a return of capital on winding up. But what happens if someone wants to change the rights of a share class? This is known as a variation of class rights. In the UK, the Companies Act 2006 protects vulnerable shareholders from this. The Articles of Association may set out class rights and provisions for altering or varying those rights. Share rights may be altered in accordance with these articles. If the Articles of Association do not have provisions for varying the rights, the company can vary its share rights by obtaining written consent for the variation from the shareholders of at least 3/4 in nominal value of the issued shares of that class. This excludes any treasury shares. Or by the members of that class passing a special resolution, which is a 75% majority at a separate general meeting. Then a special copy of the resolution, called Notice of Particulars of Variation of Rights, must be delivered to the company's house. But if no less than 15% of the issued shareholders of that class are unhappy, so they didn't consent or they didn't vote, they can apply to the courts to have that variation cancelled within 21 days of passing the resolution. If it is taken to court, nothing is ever certain. The courts may confirm the variation or cancel the variation. It will only cancel the variation if the shareholders bringing the case prove the variation is unfairly prejudicial. The courts may intervene when there has been a variation that changes the rights themselves, not a change that affects things derived from the rights, such as value or power. So, how do shareholders get shares? They are allotted. Shares are allotted to somebody under a contract of allotment. That person is then listed on the register of members and becomes a member of the company. Directors can't just give out shares. They are given the authority to allot shares by the Articles of Association or by passing an ordinary resolution. The authority they are granted must have an expiry date. The maximum time is 5 years and must state the maximum number of shares that can be allotted. In private companies, where there is only one share class, the directors may allot the shares unless the Articles of Association forbid it. When you look at the accounts, you will see ordinary shares at £1 each. This is the nominal value set at incorporation and is outlined in the Statement of Capital and Initial Shareholding. This nominal value is the extent of the shareholders' liability. It is limited to their investment. You learnt about limited liability earlier in this course. The Companies Act states a company cannot issue its shares for less than their nominal value. They cannot issue their shares at a discount. The Act also states that shares are only treated as paid up to the amount of money that has been received. So, what if you or your client buy the shares mentioned above, but instead of paying £1 a share, you agree to pay the directors 50p? The issue is still valid, but you still own the shares, but you must pay the full amount plus interest. We have looked at issuing shares at a discount. Now, what if the shares were sold at a premium, i.e. more than their nominal value? For example, the nominal value of a share is £1 and the company sells it for £1.50. This share is sold at a premium and the 50p is the share premium. This happens when the market value of the shares is higher than the nominal value. How does the company reflect this premium? The Companies Act requires that the premium must be credited to the share premium account. This account can only be used for writing off the expenses and the issue of new shares, writing off any commissions paid on the issue of new shares, issuing bonus shares. Now, let's examine some common terms that will come up either in your exams or your career. You've already looked at issued and authorised share capital, but what do the terms paid up share capital, called up share capital, and uncalled up share capital mean? Paid up share capital This is the amount that shareholders have actually paid for shares issued. Called up share capital. This is unpaid share capital that shareholders have called for but not paid for yet. Uncalled share capital. These are the shares that have not been called up by shareholders, so are also unpaid. Companies sell shares primarily to raise funds. To not dilute individual shareholders' control, a statutory preemption rights is done, where the existing shareholders are offered new shares proportionately to their shareholdings. This offer is for 21 days and is only for ordinary shares which must be fully paid for in cash. A statutory preemption rights, however, can be disapplied. If this happens, the company may have a rights issue. Next, we have bonus issues. These do not normally raise funds or cost the shareholder. This is when the company issues free shares to shareholders. They may do this instead of increasing or even paying a dividend. This reduces the cash flow out of the company, and shareholders can choose to sell their shares in order to receive a payment. The bonus shares are distributed proportionately with the shareholder's shareholding. A 3-for-2 bonus issue means 3 shares for every 2 they held before the bonus issue. So a shareholder with 1,000 shares receives 1,500 bonus shares. That is 1,000 shares divided by 2 is 500, and now they'll get 3, so multiply 500 by 3, and that's 1,500. The pros of bonus issues are the company can make a payment in kind without depleting cash reserves. With more shares issued, the company appears bigger. The cons are bonus shares do not generate any capital because they are issued for free. More shares mean that if shareholders sell the bonus shares, their control in the company is diluted. Also, the dividend per share is reduced as profits are paid out over more shares than before. Finally, let's look at a rights issue. This is when new shares are offered to current shareholders in the same proportion of their shareholding. This is to raise funds, and if everyone accepts, their control is not diluted. The company may have a rights issue when a statutory preemption rights have been rejected. Often shares are given at a discounted rate to the market value, however, not the nominal value. If shareholders who receive the rights issue don't want to purchase more shares, they can sell their rights to shares to another party.